Here's something you probably did today without thinking about it. You tapped your phone to pay for coffee. You split a bill with a friend through an app. You checked your savings balance on a platform that isn't a bank. Maybe you got a loan offer inside the software you use to run your business. Every one of those actions represents a banking function. Payments, transfers, deposits, lending that used to live inside a bank. And now it doesn't. Fintech isn't replacing banking. It's dismantling it, function by function, and reassembling those pieces inside the platforms and apps where people actually spend their time. This is the story of how that's happening, who's winning, and what it means for the banks left standing. To understand how fintech is changing banking, you have to understand what a bank actually does. Strip away the branches, the branding, and the marble lobbies, and a bank is really just a bundle of financial functions packaged together under one roof. A bank holds your deposits. It issues you a card. It processes your payments. It lends you money. It verifies your identity. It moves funds between accounts. It earns revenue on each of those functions, interchange on card transactions, interest margin on deposits and loans, fees on transfers, and account maintenance. For over a century, these functions were inseparable. You couldn't get a debit card without a bank account. You couldn't get a loan without a banking relationship. You couldn't move money without going through a bank's payment rails. The bundle held together because there was no alternative infrastructure to support any of these functions independently. That's what changed, and it changed because of three things that happened almost simultaneously. Open APIs, modern cloud infrastructure, and regulatory frameworks that allowed non-banks to access banking capabilities. Once those three pieces were in place, every function inside the bank became a product that could be offered by someone else. Let's walk through the 5 core banking functions that fintech has unbundled, and who's winning each one. The first is payments. This was the earliest and most complete unbundling. Stripe, Square, Adyen, and PayPal built payment processing infrastructure that let any business accept payments without a traditional merchant banking relationship. Stripe alone processes hundreds of billions of dollars annually. When a consumer taps to pay at a coffee shop using Square, or a developer integrates Stripe into their checkout page, the bank's role in that transaction has been reduced to holding the underlying account. The payment experience, the part the customer actually sees and interacts with, belongs to the fintech. The second is lending. This is where buy now, pay later fits in. Companies like Affirm, Klarna, and SoFi have built lending products that are distributed at the point of need. At checkout, inside a SaaS platform, embedded in a marketplace. The underwriting is automated, the approval is instant, and the borrower never interacts with a bank. Traditional bank lending requires applications, manual review, and days or weeks of processing. Fintech lending happens in seconds because the models are built for specific contexts: a $200 purchase, a small business cash advance, a payroll-linked personal loan. The banks still provide the funding and the licenses in many cases, but the customer relationship has moved upstream to the platform. The third is deposits. This one is newer, and it's accelerating fast. Neobanks like Chime, Mercury, and Revolut offer deposit accounts that look and feel like bank accounts. Debit cards, direct deposit, savings features, but they're built on top of banking-as-a-service infrastructure provided by sponsor banks. Stripe Treasury lets platforms like Shopify offer business accounts to their merchants. The customer thinks they're banking with Shopify or Mercury. In reality, the deposits sit at a partner bank like Evolve or Column. The fintech controls the experience. The bank holds the license and the deposits. The relationship belongs to whoever owns the interface. The fourth is card issuing. Companies like Marqeta and Galileo have built infrastructure that lets any company issue physical or virtual debit and credit cards. Corporate expense management platforms like Brex and Ramp issue cards to employees. Gig economy platforms issue cards to drivers. BNPL providers issue virtual cards at checkout. Card issuing used to require a direct relationship with Visa or MasterCard and a licensed bank partner. Now it's an API call. Marqeta alone powers cards for DoorDash, Square, Klarna, and dozens of other platforms. The card is branded to the platform. The bank is invisible. The fifth, and this one is underrated, is identity and compliance. Know your customer, or KYC, and anti-money laundering checks used to be something banks handled entirely in-house. Now companies like Alloy, Persona, and Jumio have built identity verification infrastructure that any company can plug into. When a neobank verifies your identity during sign-up, or a BNPL provider checks your information before approving a transaction, they're using third-party compliance infrastructure, not the bank's internal systems. Even the regulatory function is being unbundled. So if every function is being pulled out of the bank, what's left? This is where the picture gets more nuanced than the banks are dying narrative suggests. Banks still hold two things that fintechs generally don't: the regulatory charter and the deposit base. Those are not small advantages. A banking charter is extraordinarily difficult and expensive to obtain, and deposits, especially insured deposits, represent the cheapest source of funding in financial services. What's happening isn't that banks disappear. It's that they're being restructured into two categories. The first category is infrastructure banks. These are the banks that have accepted that their future is powering fintech products rather than competing with them directly. Goldman Sachs providing the banking infrastructure behind Apple Card. Cross River Bank powering lending for Affirm and Coinbase. Column building a bank specifically designed to be accessed through APIs. These banks make money on volume. The more fintechs and platforms that build on their rails, the more transaction fees, interchange revenue, and deposit balances they generate. The second category is relationship banks. These are the banks that compete on service, advice, and trust, primarily in wealth management, commercial banking, and complex lending where human relationships still matter. Your local community bank that knows your business, the private banker who manages a family's wealth. These banks survive not because they're technologically superior, but because their customers value the relationship more than the convenience of an app. The banks that are struggling and will continue to struggle are the ones in the middle, too big to compete on personal relationships, too slow to compete on technology, and too tied to legacy systems to become infrastructure providers. They're losing payments to Stripe, lending to Affirm, deposits to neobanks, and card issuing to Marqeta, one function at a time. Here's the takeaway. Fintech isn't replacing banks, it's unbundling them. Every core banking function, payments, lending, deposits, card issuing, even compliance, is being separated from the traditional bank and redistributed to technology companies, platforms, and infrastructure providers that can deliver it faster, cheaper, and closer to the moment the customer actually needs it. The banks that recognize this shift and position themselves as infrastructure, the regulated foundation that fintechs build on, will thrive. The ones that try to compete with fintechs on user experience while running on 30-year-old core systems will lose, slowly and then all at once. If you want to understand how the infrastructure layer underneath all of this works, the BaaS providers, the APIs, the sponsor banks, watch this video next. And if you want to see the most successful example of fintech unbundling in action, our breakdown of how Buy Now Pay later actually works is here. Subscribe for 2 videos a week on the infrastructure and business models behind modern finance. No hype, just how it actually works.